When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Income, legacy, growth, it's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn more. And now we have a great show for you today. Great podcast. We're going to talk about some really interesting things here. There's been a lot of conversation about the economy and finances centered around taxes and inflation lately. One thing we have not discussed on this podcast lately is the current state of the stock market. What's going on? What can we see coming? And is there any action we need to think about taking? Dave Lopez is here today to get us all up to date and well informed. Dave, how's it going, my friend?
Things are going well. It's sure good to be back on the podcast with you, Ron. I always enjoy our time together.
Yeah, we have a lot of interesting things to talk about today. And I know that, a lot of people may be turning their attention to the stock market recently. A lot of changes in, a new administration and all that kind of thing. So bring us up to date on what's happening right now and what we should be concerned about.
Yeah, so what's in the news now that you might see if you're reading the financial press is when they talk about last year and where we are this year with respect to the S&P 500, which I just want to remind everybody, you see that on the news, the S&P 500 is up or the S&P 500 is down. Many folks in sound bites might say, so you see the market is up. Remember, the S&P 500, Ron, is a small part of the overall world economic market. Right? It's just a sliver we can look at, which is mainly roughly 500 large U.S. companies. So it's looking at the large U.S. companies as a part of the market. Mm-hmm. Now, with that said, what's been a topic of discussion lately is that the S&P 500's return last year in 2024 was very heavily concentrated. The term we'll use is market concentration in just a few companies. So just 7 companies of the 500 roughly in the S&P 500 resulted in, it was about 37% of the total market value of the S&P 500.
Wow.
So let me kind of walk you through that again. Was a kind of a word salad, wasn't it? So you take the S&P 500 and you say, okay, well, how big is that? What part of the overall market? 37% of the S&P 500 is comprised of just 10 companies.
Yeah.
Right? So that's what we call market concentration. So a lot of times when I have this conversation, the first thing that pops up is I'm not quite sure what that means, market concentration, or how the S&P 500, how do they decide? How does that work? If you have 500 companies, isn't each company worth 1/500th of the value? And the answer to that is no, right?
Yeah.
The S&P 500, Ron, is what's called a weighted index. And all that means is the bigger the company is, the bigger portion they give it of the S&P 500. Does that make sense?
Yeah, it does. And I'm wondering, is it really good to focus that much on the 7 largest companies, when you're looking at the S&P 500?
Yeah, so that's a good question. So when they decide, how do they decide who gets the bigger part and who gets the smaller part of the S&P? And when they say a company's bigger, how do they do that? Well, there's a lot of ways you could value a company. But the way that the S&P does it, and a lot of folks will use this as a measure when they're looking at companies. We'll talk about it later in the podcast, but you'll hear the term market cap. Have you ever heard that term before, Ron?
Yes, I have, but I'm not exactly really conversant with what it means.
Most folks, they've heard the soundbite. It's short for market capitalization, and that's just a fancy way to say, hey, we need some metric, right, to value the size of a company compared to another company. This metric is called market capitalization or market cap. And all it is, it's really quite simple. They take the price of the share of the stock times the number of shares that have been sold or outstanding. So imagine if, Ron, you've got a company, Ron's baseball caps, right? And it's $50 a share is your stock price.
Okay.
And you've issued 1,000 shares out to the people in the public. So there's 1,000 shares outstanding. Mm-hmm. Times $50 a share, your market cap is $50,000. 50 times 1,000 shares.
Okay.
Right. Now notice that doesn't take into consideration your cash flow or how profitable you are or how much infrastructure you've got. Those are other ways to value companies, right? Okay. So we all, we pick and choose. But for this one metric is how the S&P values it. So they decide how much of the S&P, your company, what did I say was Ron's baseball caps, right? How big of the S&P 500 Ron's baseball caps is determined by your market cap.
Mm-hmm.
You with me?
Makes sense. Yeah.
So that's what, when you hear someone say the S&P 500 is a weighted index, it means each company, the percentage they participate or they're calculated into the S&P is the exact proportion of their market cap. So Ron's baseball company is worth $50,000. If the whole S&P was worth $500,000, mm-hmm. you would be 10%.
Yeah.
Right? So your company would account for 10%. So what all that means is that these bigger companies, when they go up or down in value, they affect the S&P 500 much more than a little company. It's not an even 1/500th each. So that's market cap, and that's how the S&P. It's very important that we understand how the S&P works.
Okay.
Now, with that said,
right.
With that said, I want to go back to what we just said. Now that we understand how they just build the S&P and what market capitalization is, the top biggest 10 companies based on market cap that are in the S&P 500. Represent 37.5% of the S&P 500.
Oh, I got it.
Right, so almost 40, when you see the S&P 500, 40% of it is 10 companies, which means the other 60% is the other 490 companies.
Wow.
Right, so all that means is that if something happens to one of those 10 companies, it's going to affect the S&P dramatically compared to if something happens to one of the other 490 companies.
Well, it makes a lot of sense. And the stock market is really concentrated more so than it ever has been in the past, from what I'm hearing.
That's right. So market commentators, that's one of the things that their points would be. That is called market concentration. It's important that we understand that term. Right, and they might say, hey, this is bad, all this market concentration. We're over-concentrated in so few stocks. Mm-hmm. But would it surprise you, Ron, if I told you that we're not necessarily over-concentrated compared to historical numbers?
Yeah, it would. Why do you say that?
Yeah, so it's been, there's points in the past where the market's been even more concentrated. So I'll give you a couple examples. But before we get into that, I would suggest, I want to jump the shark on the idea. I would suggest that market concentration isn't the problem.
Yeah.
Right? It's what's called market overvaluation. So it's not that we have too much value in a few companies. It's that the market as a whole is overvalued.
Okay. Should we be worried about this situation?
Well, it depends, right? How capable you are of counteracting, right? And when I say counteracting, I mean, what's your risk tolerance? Are you able to leave money in the market long term if it crashes? Mm-hmm. Do you have time to leave it in the market, right? So the market is by nature volatile. So if you think the market's overvalued or if you think it's too concentrated, what does that mean? Well, it really just means, hey, I think there might be a correction in the market. We might be overdue for a correction. It's only a problem if you're unprepared to leave the money and let it sit, because historically, if you let the market sit over long periods of time, it does recover, right?
Yeah.
So I think a few steps to be comfortable understanding are just some basic facts here, and I want to kind of reiterate a couple of those. So here's a couple of basic facts about the market that we can talk about today.
All right.
We would go talk about market concentration again. More than half of the S&P 500's return last year, that its total return last year was right at 25%. Incredible rate of return if you invested in the S&P 500.
Really?
Right? Now, again, there's a point, right? Somebody might listen to this and say, hey, my account didn't go up 25%. Well, that's because the whole stock market didn't go up 25%, just the S&P, which is, as we talked about before, a small piece of the market.
Okay.
Right?
All right.
So the S&P went up about 25% last year. Okay? Of its 25% return, half of that return was generated by 7 companies. They call them the Magnificent Seven, and they're 7 of the 10 biggest companies. That's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Those 7 companies, you'll hear them referred to in the financial press as the Magnificent Seven because of their size, right? Half of that 25% return was them.
That's amazing.
It's amazing. Now, get this. NVIDIA alone, which was one of those 7, it had a return last year of 171%. So its return alone, because of its size, was basically 20% of the stock market's gain last year, the S&P 500's gain. So that's market concentration. The dominance of a handful of companies is market concentration. But here's what's interesting. It's not unusual, right? Tech stocks total about 31% of the S&P 500 market value today. Yeah. So you're heavily, if you're in the S&P, whether you know it or not, you're heavily concentrated in tech stocks, right? Now, why is that interesting? As someone might say, oh, I'm really diversified because I've got half my money in the S&P 500 and the other I'm in the tech industry in the NASDAQ, which is an index that focuses on the tech industry.
Right.
Well, most people would then be shocked to realize that, hey, I have much more exposure to tech than I thought, because 31% of the S&P is also in tech, and all of the NASDAQ is in tech.
Well, it's a real tech world, isn't it?
Well, it just means that people need to be very careful when they think they're diversified, and you have to look beyond just the names of the indexes and have to run an analysis to say, hey, when you break down these indexes, what actual stocks am I holding? If I'm holding 4 different mutual funds, I want to make sure I'm not overly concentrated in one sector, like the tech sector, more than I want to be. Now, if you want to be heavily in this tech sector, then that's fine, but you just want to make sure where you are. You can get your financial advisors to run a report for all of your accounts, and it will break down literally what individual stocks you have exposure to. Even though you may not own a stock, you may just own a whole bunch of different funds. It's a very powerful report. We do it for our clients. If you're one of our clients and you're listening, it's probably been done for you, but if you'd like it done again, ask if we'll run a Hidden Levers report for you. If you're not with us, get with your financial advisor and ask them if they'll run that report. But back to this idea of concentration, Ron, because I know that's where you were going, and thanks for keeping me on track. Remember how I said that we weren't the overvaluation or the concentration in just those 7 to 10 companies in the S&P is not really that unusual?
Yeah.
Right? Well, right now, you would say tech stocks are concentrating the market. 31% in the S&P 500. In 1812, just to pick another period in time, the financial stocks, that's banks and insurance companies, they made up, get this, 71% of the total United States stock market capitalization.
And that was certainly a long time before all this stuff in the tech world.
That's right. But it just shows you that in that period, they were heavily concentrated, just in a different sector. Right? In the 1900s, railroad stocks, 63% of the stock market.
Wow.
Right? One particular railroad, the Pennsylvania Railroad alone, was 12% of the U.S. stock market.
That is incredible.
Right? And to give you a perspective, today's biggest stock is Apple.
Yeah.
And it's under 7% of not the whole market, just the S&P 500.
So it's not nearly as extreme as it was back then, although it was in a different sector.
Yeah, those are periods where it was much higher, right? There's also been periods where it's been lower, right? So it's not clear that a lower concentration is better. For example, the top 10 stocks, right, in the U.S., their market value back in the mid 60s had fallen to about 30%. So in the 60s, you pick the top 10 stocks, they were only about 30% of the market. Okay. And then between the 60s and 1981, they dropped that in half. So they were about 15% of the market value in 81. So very little market concentration. But despite that, during that period of the mid 60s to 1981, what you saw in the market was a long period of declining concentration in stocks, but you saw returns that were well below long-term market averages. So the market underperformed in that period of roughly 15 years at the same time that the stock concentration was dropping. So that's to say, I don't see a big correlation there between stock concentration and good returns in the market. So all you need to know with respect to the indexes like the S&P is that there's a lot of factors going on that can affect the market. Stock market concentration is one, right? Another one to think about is when you look at the S&P or any of these markets, it's just one way to kind of get a snapshot of the market, but that snapshot isn't always an accurate view of everything. And I'll give you an example. If you're looking at the S&P 500, their returns are in the industry what are called positively skewed. Now, all that means, that's a kind of a fancy term. All that means, Ron, is that because you're holding stocks, the S&P, remember, they hold 500 of the biggest stocks. And if a company falls out of favor or loses too much value, one, it could go bankrupt and the stock price could go to zero, right? But if it falls too far, before it went to zero, they'd move it out of the S&P and move another company in,
sure.
Which means, just a big picture, there's a downside limit to how far the S&P could drop, because the worst it could do is a company could lose all of its value. But again, before that would happen, they'd probably move it out of the stock market and the S&P and replace it with a different company. But on the upside, it's an unlimited upside. So a company could double or triple or whatever it wanted. So when you look at the results, that's what they call positively skewed.
Yeah.
So based on the data, based on the history we just talked about, and thanks for bearing with me as we got to that, we've got a little bit more of a comfortable understanding with what we mean by market concentration.
Yeah.
I would suggest that there isn't necessarily an optimal level of market concentration of the top 10 or 15 companies. There's no bright line or marker where if we went over a certain market with over concentration that it's a bad thing with the biggest stocks. I would suggest the big risk isn't market concentration at all, as we just saw, but it's actually market overvaluation.
Yeah.
Right?
It's beginning to make sense now, Dave.
Okay. So let's talk a little bit about market overvaluation. So we'll stick to the S&P since we're talking about that, but you could have this discussion about any index in the market. But the S&P, as to roughly here in February, is trading at 22 times what analysts expect the companies in the S&P to earn over the next 12 months. So what that, in our industry, you might have heard the term P&E, price to earnings ratio.
Okay.
That's what that is. It's the price of a stock, right, divided by its earnings. It's just another metric, right, to measure one company against each other's. So if its P&E is 22 times, it means the price of the stock, right, is 22 times higher than what its annual earnings are.
Okay.
So that's, take it for what it's worth. It's just kind of think of it as an arbitrary value, but it's a way you could compare two companies. Does that make sense?
Okay.
Now, right now, the S&P, if you add all of the price to earnings for all of the companies in the S&P, they're trading at about 22 times the earnings of the S&P over the next 12 months.
That really seems like a lot.
It is. The average since 1990, so what's that, last 35 years? The average price to earnings ratio is 16.4 times. So that tells you it's the cost of the stock based on earnings is higher than it has historically been over the last 35 years. That's why the P&E is such a valuable metric to people, right? That gives you a snapshot. Am I paying more for this stock based on what it produces than historically people have paid for these stocks? And right now we're paying 22 times earnings. Going back to 1990, we've been averaging 16.4 times. Now, it goes further than that. Remember I said that's one metric to measure a company? Mm-hmm. Just about by every other measure our industry using, and that would include price to sales, that would include cash flow, it would include book value, it would include past earnings, long-term inflation-adjusted earnings. But any of these different ways they measure a company's profitability, by any of them, stocks are within a whisker, a hair of multi-decade highs. So we're overvalued based on historical averages of all of these metrics.
Yeah.
Right. So even after the stumble that tech stocks, for people who didn't watch, took a little stumble in January. So even after the tech stocks pulled back just a little, the Magnificent Seven, remember I just told you right now the S&P is trading at about 22 times price to earnings, right, and that the historical average was 16. Those 7 stocks, the Magnificent Seven, are trading at 43 times earnings.
Shouldn't we be concerned with all this?
Well, yeah, historically, right, when companies are overvalued, we're overdue for a pullback or a correction, right, to get more in line. That's how come you end up with averages, right? You end up with averages because sometimes the stocks trade above the average and sometimes they trade below. Well, we're above the average, and some of the stocks, like the Magnificent Seven, are way above historical averages. Now, you also a way to measure that, you can measure what they call a stock's relative risk of a stock, comparing it to what you would get in something super safe, like a treasury note.
Right.
And with a 10-year government treasury at 4.4% currently, that's about where it is, and the price to earnings on these stocks at 22 times and the Magnificent Seven at 43, you could say that the relative risk you're taking on stock to get a better return than Treasury is higher than it's been in years, right? So that would be the takeaway. So it doesn't mean we get out of the market. It just means, hey, we're overvalued compared to data, historical data. Usually that results in corrections, right, or adjustments, so we get back to averages. And relative to safe money, treasury notes or CDs or something, we're taking more risk to get a better return than we have in the past.
You're listening to the Retire Your Way podcast with Dave Lopez of ILG Financial. And if you are fascinated by all these numbers as I am, let me give you this phone number so you can call and have a conversation with Dave about all of this, 540-720-5656. Now, back to our conversation. What are all the takeaways from all these incredible statistics that you've been throwing at us today? What are the things that we should leave thinking about after learning all that?
Yeah, so that's a great way to say it. It's fun to kind of run through the numbers, but we can get lost in the numbers. So we have the numbers, but then the real question is, so what, right? The takeaways would be this. The popular belief has always been the stock market always outperforms the bond market or other safe vehicles if you hold them long enough. I would suggest that they are likely to outperform, but you can never be completely certain that over periods they're going to outperform on the long run. And over shorter terms, and by shorter terms, remember everyone's using different criteria. By long terms, most folks are saying 20 to 30 years. But when you get on shorter terms, 10-year windows, it's a coin flip, right? Roughly from 2000 to 2012, a lot of people forget this, but they call it the lost decade in the stock market. The S&P roughly ended up right where it started. So 12 years of nothing. You'd have made more money in a 2% CD probably over that period than the market, right?
Yeah.
But the 10-year window before that, the 90s, were 10 of the best years the market ever saw. Great returns. And the 10 years after that, roughly 2010 to 2020, were 10 of the best years the market's ever seen. So the average over 30 years comes in where historical averages come in. But when the takeaway for folks in or near retirement is, don't get caught up on historical averages on the market unless you're willing to put money in the market and not touch it for 30 years.
Yeah.
Right? And
As we have discussed so many times before, I mean, if you're in your 20s, 30s, or 40s, you can pretty much count on these things to, balance out over time. But if you're very close to retirement, you don't have that much time. And so you need to really be on guard for that.
You do. And the reason you can be so aggressive in your 20s and 30s and 40s is that you have another asset in your 20s, 30s, and 40s to hedge against the market crash, or to allow you to give it time to recover that you don't have in retirement. And that asset is called human capital. And all that is the value in today's dollars of the money you're going to earn over the next 20, 30, or 40 years that you plan to work.
Yeah.
Right. So what that means is if the market crashed today, Ron's, you're 20 years old, you're planning to work 40 more years, you're in a position that you can leave it in the market for 40 years because you can count on your salary for the next 40 years.
Boy, I wish I were 20 years old.
Me too, right? That's called human capital. But when you're 60 and you're like, hey, I've got 2 more years of work, you've only got 2 more years of income or human capital. After that, you're going to have to tap your money, which means you may not be able to let it sit for 30 or 40 years in the market.
Sure.
Right? So as your human capital starts to shrink, you get closer to retirement. You just need to be more cognizant of the fact that when they say market averages, they're talking about 30 years, not 3 years or 5 years, right? So what can we do? A couple things. If you're in or near retirement, recognize you no longer have decades of paychecks coming in and human capital that you've lost as a hedge against market corrections. So with respect to the market, one thing you can do, Ron, is you can make sure you're diversified into businesses that are in countries outside the U.S., international stocks, because over the last 10 or 15 years, they have underperformed. So it's a different discussion than we're having where the S&P is overperformed, where it might be due for a correction. The argument could be some of these international companies in Europe and Asia and parts of the rest of the world have underperformed the U.S. over the last 10 or 15 years. So they maybe have price to earnings ratios that are lower than their average. So that can kind of help you hedge yourself a little bit moving into those. But the other way is because we've lost that human capital, Ron, because we're in or near retirement, you need to make sure, the rule of thumb would be whether you're 20 years old or whether you're 70 years old, the money you put in the market, both the U.S. and the international markets, based on how the markets perform, Ron, you want to be willing to leave it in there untouched for a minimum of 5 years. And I would tell folks usually 5 to 7 years to give it a chance to recover from a market correction.
Sure.
And that's regardless of what's going on in your life or how much money you need or what's going on with your kids. You need to be prepared to leave it and able to leave it 5 to 7 years to recover. Well, if you're working, you can do that, right? Because of the human capital that we talked about. If you're retired and we don't have that income coming in, then what all that means is we need a portion of your money in vehicles that are not subject to market risk. So they won't go down because the stock market crashes. And that would be things like bonds, CDs, or bond replacement vehicles. And all that is a fancy term for other investments. And there's several other investments that act like bonds and CDs and that they protect your principal, but they give you a chance to do as good or often better than a bank or a bond or a CD. Several of them. This isn't a podcast about those. But my point is, you want enough money in those type vehicles that are protected from the market so that you could use those funds for 5 to 7 years if you needed to cover your needs while you let the money in the market recover.
Yeah, for sure. It's all about strategy. And, if you are a client of Dave Lopez or Chase Lopez at ILG Financial, you will have the opportunity to work with some of those strategies. Dave, thank you so much for explaining all this stuff today. I've learned a lot. I know that everybody else has.
Oh, great. I hope it wasn't too much in the weeds, but sometimes we just got to get in the weeds a little so that we're all using the same terms and we understand what they mean, because it's kind of silly to talk about a term if everyone's like, well, I don't even know what that means. So that was the hope. I hope I did okay today doing that.
Well, there's always something new to learn. And I know that even as long as you've been doing this, you still learn things every single day about
Every day.
this whole financial industry. So thank you so much for sharing your opinions today, and hope everybody will soak all that in. When it comes to retirement, do you want to have the same old plan everybody else has? No, you're unique. You have your own goals and dreams. Don't be treated just like a number. This is your retirement, so it's time to think differently. And you have been in luck today because you have been tuned in to the Retire Your Way podcast with the inimitable Dave Lopez. Now you are one step closer to learning what a customized retirement strategy can do for you. Thank you so much for listening to the ILG Financial Retire Your Way podcast. I'm Rod Stutz with Dave Lopez. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.